Welcome to the Australian Business Executive Podcast, where we speak with Australia's most influential industry professionals on the business and economic development issues taking place across the country. You can stay up to date with all our content, including our magazines, podcasts and videos, by visiting www.theabe.com.au and clicking on subscribe.
Michael is a leading corporate restructuring advisor and insolvency practitioner with significant experience assisting companies that are underperforming, facing financial distress, or in need of financial restructure. Michael is a director in William Buck's business recovery team, which focuses on the middle market, in particular owner-managed businesses, enterprises, and mid-market ASX-listed companies. He is also vice president of ARITA, which is Australian Restructuring, Insolvency and Turnaround Association, Australia's leading organization for restructuring, insolvency, and turnaround professionals. While in the U.S., Michael gained valuable experience working on corporate restructurings under the U.S. Bankruptcy Code, including some high-profile Chapter 11 engagements. He is an accountant, a registered liquidator, and obtained his MBA from Columbia University Business School with a focus on finance and strategy, which included courses on turnaround management and assisting companies in financial distress. Michael was admitted to Beta Gamma Sigma, the Honor Society for Collegiate Schools of Business, in recognition of high academic scholastic achievement. That is a mouthful. Thanks for joining us today, Michael.
Thank you very much for having me.
So from the top, can you just explain the role of a restructuring advisor and the service they provide to a business?
Certainly. A restructuring advisor is typically a qualified professional advisor appointed when a company is facing financial distress, or if a company is likely to be facing financial distress in the near future if action is not taken in the short term to fix the issues being faced by the company. There are a multitude of roles that a restructuring advisor can take depending on the circumstances being experienced by the company. The government has recently introduced new safe harbour legislation which provides protection for directors from being held personally liable for the debts of a company. Before the new safe harbour legislation was introduced, directors of a financially distressed company who were attempting to rescue the company had to contend with our previously draconian insolvency trading laws, which placed directors at personal risk for any debts being incurred by the company. Restructuring advisors are now able to assist directors of a financially distressed company to obtain protection against being held personally liable for a company's debts. While the directors may have been attempting to rescue a business to continue trading and to maximize return for all shareholders, including the shareholders, management, employees, customers, the suppliers, the risk of personal liability fell squarely on the shoulders of the directors. Another role that a restructuring advisor can undertake is to assist a company in dealing with its banks and its secured creditors. A restructuring advisor can also play a major role in assisting management of a company to develop one or more restructuring plans to save the company and avoid insolvency proceedings. A restructuring advisor can also assist a company to negotiate new arrangements with third-party suppliers and creditors to provide the company with additional time and funding to develop and implement a restructuring plan. Other roles a restructuring advisor can undertake include providing assistance in raising equity and debt. The bottom line is that restructuring advisors have significant expertise and experience in managing the multitude of issues which arise for any company facing financial distress. Existing management frequently do not have the necessary experience or the capacity to deal with additional workload which arises in these situations. Management will frequently find that they're just putting out fires and they just don't have the bandwidth to deal with the issues to ensure the survival of the company. Frequently, a restructuring advisor will work in conjunction with management with other specialists such as legal advisors, media, forensic, IT, and even cyber advisors, as well as industry specialists. At the end of the day, the restructuring advisor's role is to assist the company to achieve the best results and to maximize the chance of the company continuing as a going concern, thereby protecting value for the company, for all stakeholders, and particularly, most importantly, retaining jobs for the employees.
With that information then, Michael, Who should be engaging a restructuring advisor?
In times of financial uncertainty, really all stakeholders should consider engaging a restructuring advisor, whether that's the board of directors, the CEO, the CFO, senior management, lenders, shareholders, creditors, advisors. Basically, any stakeholder that's involved in dealing with a company in financial distress should consider bringing in the assistance of a restructuring advisor. We frequently brought in by financiers or secured creditors and even suppliers to distressed company, all who can benefit from advice that can be provided to them in how to deal with the company and how to maximize their position. We are seeing more and more frequently where the company's management's bringing in a restructuring advisor with the tacit approval of their banks, who are able to gain some comfort that the company's management are being properly advised by independent advisors who can assist them through the process. And it just brings a level of credibility to the restructure that wouldn't be there otherwise.
I think there's a common misconception about restructuring that, when you're engaged, you're either there to chop up the business or liquidate it. So, realistically, what options become available to a client once they reach out to somebody like yourself?
The range of options expanded dramatically over the course of the last year when the government introduced the new safe harbour legislation. Before the safe harbour legislation, directors of any financially distressed company who were attempting a restructure had to deal with the draconian insolvent trading laws, which placed directors at personal risk. Restructuring advisors are now able to assist a company and assist the directors to obtain protection against any risk of personal liability, which is just a groundbreaking change in the local market. Provided directors meet certain minimum requirements that are set out in the Act, directors are now able to obtain the benefit of the safe harbour protections. One of the basic, most important steps in that process is that the directors appoint a properly qualified restructuring advisor. The directors then should, in conjunction with the restructuring advisor, work to develop a plan which is reasonably likely to lead to a better outcome for creditors than would be obtained from immediately liquidating the company. And in most cases, that's reasonably easy for a restructuring advisor to work on and to put in place all the safeguards. In addition, the restructuring advisor will then work with the management and the company to implement the plan. Our experience as well, in addition to the safe harbour protection, really at the end of the day, directors actually are most focused on actually saving the company. And in that respect, it's important to be able to provide additional support and expertise to the company in addition to just purely the safe harbour portion. In that regard, we were able to provide assistance in terms of balance sheet restructuring, assisting with cash flow management, assisting in raising capital, assisting in dealing with banks and secured creditors. So there's a whole range of avenues that the restructuring advisor can take to assist management.
Okay. And a lot of businesses don't have the foresight to see that restructuring is needed until it's too late. When should management be considering getting in touch with a restructuring advisor?
Unfortunately, it's far too common that we see the scenario where management and the board really are in denial and don't reach out for assistance from a properly qualified restructuring advisor until it's too late. The bottom line is that any successful restructure will always take both significant amount of time and funding to complete. It's interesting, if you compare to the US, where it has a reputation of a strong business rescue culture and is regarded as very entrepreneurial and creating jobs because of the approach they've taken. If you actually look at the US bankruptcy law, Chapter 11, while it is held as a benchmark for restructuring, it's actually a very cumbersome, very expensive process, which requires a lot of upfront funding and a lot of time. And I think the common theme that comes out of it, companies and management need time and funding available to enable them to put a restructure in place. It just doesn't work if management waits till they start to see the early warning signs of and start to see actually the evidence of insolvency. They actually can't pay their debts. It's too late. The management needs to act as soon as they get an indication that the business is facing some degree of financial distress. If they reach out early enough, they give themselves the best chance of actually saving the business and therefore protecting jobs and benefiting all stakeholders.
Okay. And, hopefully restructuring is not an area that a business is too familiar with if they're healthy. But, considering most businesses don't know what they're looking for, how should they go through the process of selecting a restructuring advisor?
You're absolutely right. I think the last recession in this country was almost 30 years ago. So it's fair to say there's a fairly small pool of local directors who've had much experience in appointing a restructuring advisor. The bottom line is any business looking to appoint a restructuring advisor needs to make sure that the advisor has a broad base of turnaround, restructuring, and insolvency experience. From our perspective, the obvious and admittedly self-serving answers: contact a member of the William Buck Business Recovery Team.
Of course.
We obviously have an experienced team focused on the middle market who have a strong track record in assisting companies in financial distress. But to expand beyond that, and more broadly, I would recommend that a board look at any of the RETA professional members. RETA professional members have a broad expertise in finance, accounting, and law. They need to undertake the rigorous RETA post-qualification course, and they're held to high regard. At the end of the day, restructuring advisors become a trusted advisor to the company and management, and the board needs to have confidence that the advisor has the appropriate expertise and experience to assist them in challenging times.
Mm. And could you give us a few examples of recent engagements where you've been appointed as a restructuring advisor?
The majority of restructuring advisor assignments we undertake are normally undertaken on a confidential basis outside of the public eye. So certainly it's not up in lights. Our perfect example is where we're able to assist a company to recover, save the business, and all of that is done outside of the public eye. But if I can provide a couple of examples, probably not surprising given the difficult retail environment we've experienced in this country over the last few years. We were approached a little while ago to take the role as safe harbor advisor to the directors of a retail company. The business was faced with sharply declining revenue. The management had not foreseen the changes to the business and was struggling to react in time. While management had been desperately trying to stem the declining revenues and were looking for alternative growth areas, they weren't meeting with much success at that point in time. Our initial role was to advise as purely a safe harbor advisor, but that role quickly expanded to assisting the CFO engage with the banks, and in particular the workout area of the bank. We very quickly found after our appointment that the company had actually been dealing with the workout area of the bank already, and the workout side of the bank clearly had a very, very different view as to the company's prospects. And we found we were almost acting as translator between the company and the bank. While the bank had clearly, or thought they'd clearly signaled to the company that they had some serious questions on the viability of the business, and the bank was looking at its alternative and its exit strategies. Management of the company, on the other hand, was looking at how do they grow out of the current predicament. So in one sense, we almost acted as translators between the bank and management for a while. We then worked with both management and the bankers to put a restructuring plan in place Part of that was to develop a detailed cash flow model which set out the basis for the turnaround of the business. And on the back of that, we were then able to assist the company to negotiate a 12-month forbearance agreement, subject to a number of conditions, one of which was that the company raised capital. During the process, we had to assist the company to renegotiate the forbearance agreement again. And following that, the company, with our assistance, was able to raise capital, which was then used to partially pay down the bank, and also then the balance was used to shore up the solvency of the company and to provide for growth of the company. Our role ceased shortly thereafter on the basis that the company then was clearly solvent. It had a solid base on which to continue operating, and was a great result in the sense that the management, the directors, the bank's shareholders, and most importantly, the employees all got something out of it. The employees, while there were some minor redundancies, the vast majority of the company continued operating, value was retained, and the business continued operating.
Excellent. Look, that's about it for our time today, Michael. Before we finish up, is there anything else that you'd like to add?
I suppose just a comment that the directors cannot act too slowly in reaching out to a properly qualified restructuring advisor to get assistance. Don't wait. Everyone loses. We see it far too often where companies wait too long, and at the end of the day, employees lose their jobs and the company is in liquidation. If management and directors act much earlier and reach out to properly qualified advisors and get that advice, they improve the prospects of the company continuing to operate significantly.
Excellent. Well, thanks for your time today, Michael.
Thank you very much.
This has been a production of the Australian Business Executive, a division of Romulus Rising Proprietary Limited. All rights reserved. You can stay up to date with the Australian Business Executive, including our magazines, podcasts and videos, by visiting www.theabe.com.au and clicking on subscribe.